Welcome to The Grasp. I'm Doug. We continue our trader series by looking at market cycles. So break out your thinking caps and let's get it. As traders, we are simply looking for the best opportunities to profit. Every other trader is doing the same thing. And as we know, it is not fundamentals that move the market, but fear and greed. So what we are trying to do is follow the smart money and look for an opportunity to get on board those moves, and then use our intelligence and the tools that we have to get out before it all comes crashing down on us. As we will discuss, the market is made up of waves, and large waves are made up of smaller waves. If we get our entries right, you put the majority of the trading equation in your favor. All markets are made up of cycles, and those cycles are broken into four main stages. The first stage always occurs following a downtrend. Everyone who wants out has gotten out. This is a time of repair, and it allows investors time to get drawn back into the cycle itself, leading to, of course, the second stage. This is the greed stage. This is the stage where no one wants to miss out and a solid uptrend is put into place. The third stage is a period of exhaustion. The equity is tired. It's been running up and up and up, and demand has evaporated. The pros have gotten out, and it's the novices who are late to the party who are driving it now. This is usually characterized by uncertainty, wild swings, and sloppy overlapping candles. And of course, this is followed by the fourth stage, which is nothing but fear. Fear of losing profits by those who've held for too long, hoping to get further gains. Here is a simple example. This is a monthly chart. And can you see the cycle? Can you see the larger cycle? Do you see that it's repeating itself? And do you see that in each one of these cycles are smaller cycles? Here's an example of a daily chart. Can you see the cycle? Can you see it repeat? Do you notice that within each one of the larger cycles you see smaller cycles? Understanding this concept helps us in multiple ways. First of all, it allows us to stay in a frame of mind to keep the larger context in mind, so that if something is moving in an uptrend, we aren't looking to go short, right? It keeps us focused on the larger bias. The second thing it does is it reminds us that, look, these things move in cycles, which means that if you miss this trade, there will be more trades ahead. And the advantage of this is it tries to keep us focused and out of the fear of missing out, because that is a dangerous trap that every trader falls into. And so our idea here is we want to be focused on making reliable decisions.
I'm just a blonde monkey to you, aren't I?
You said it, not me.
We'll reference this chart to talk about the first stage here. This is a daily chart. Now, first stages come in many varieties. Often they'll be seen as a consolidation with low volume. Sometimes, though, they can be a V-type reversal, and those are very difficult to catch. But often they'll appear as rounded bottoms on decreasing volume. In all cases, most everyone that gets out that wants out. The first stage ends with accumulation, almost always by institutional buying, and that is who we want to follow. So as you'll notice here on this this chart here at A, notice that A is a long consolidation. The chart really doesn't seem to go anywhere. It's just kind of moving sideways. It's followed by an aggressive move down at B. And then you'll notice that it rises right back up to the previous consolidation era at C. This is a very bullish sign of accumulation, and you will often see this type of pattern. Second stages are easy to identify. Everyone knows what that looks like. They're almost always accompanied by a massive increase in volume, and if you happen to miss the entry or the change from a stage 1 to a stage 2, there will be multiple opportunities to get on board throughout the stage 2. Trading aggressively early in this phase leads to maximum profit. traders should be attentive and avoid getting in late and staying too long. So notice that candles should be clean, without a lot of overlap or separation. The steeper the angle, the more likely it pulls back. So don't overlook large gaps. Secondly, a strong, reliable second stage move at approximately a 45-degree angle is much more easy to maintain itself. If it gets too steep and sharp, it cannot continue in that way without a significant pullback. After the second stage comes stage 3, and this is by far the most difficult stage to recognize and trade. This is where most novice traders lose their money, mainly because they get into the game too late, and because they just got in, they are hesitant to get out, and they don't recognize that the trend has changed.
I will now consider the evidence.
Third stages are much more sloppy, and they're characterized by overlapping candles and more volatility. The candle sizes will generally be much larger than other parts of or other trends because there's a lot of volatility going on. Let's look at this chart. Again, it's a daily chart, but as you can see, after an extended run up, the equity needs to rest. But notice how the candles are much larger than they are in other areas. Notice how there's a lot more overlap. It's not clean like it is in A and B, but when you get into above B at C and D, you'll see that the candles are overlapping and sloppy. You don't get a nice clear trend in any direction, and this is where a lot of people lose their money. The fourth stage is the downtrend. It's created by stops getting triggered. Panic sets in and everybody runs for the exits. It's usually much faster than the other trends, and there are opportunities there for people interested in going short. Notice this chart here. After the sloppy candles in stage 3, notice the enormous engulfing candle at A. The damage is done, and by closing under the lows, stops are automatically triggered. And notice a weak retracement at B, but the thing is done. The damage is done, and we are heading down. This cycle is universal. It doesn't matter what markets we're talking about, whether it be stocks or options or futures or cryptocurrencies, it is always in place. Fear and greed move markets, not fundamentals. As such, we must always be evaluating. We have to be prepared to change our bias when information we are collecting from the charts tells us that something is changing. And, as always, we need to have a plan in place for every single stage. That's all for now. We'll see you next time back here on The Grasp.